So I just want to be clear, everyone. I was supposed to go at 1. I'm going a little bit early so you don't get confused. So I'm Robert Murphy. I'm an economist, and as she said, I'm the author of, it's called Understanding Bitcoin. My co-author is Silas Barta. Silas, he's here in front. So he's more the cryptography kind of programming guy, and I'm the economist. And so it's a free PDF. I just want to point you to the website, understandingbitcoin.us. Just a little crowd interaction. Do you guys know why we picked the domain name understandingbitcoin.us as opposed to .com? Any guesses? Because .com was already taken. That's why. Okay, so this is the mnemonic to get you guys to remember the URL. Okay, so I have a very brief time, obviously, here, so let me just explain to you guys why, as an economist, I'm interested in Bitcoin with my background and how I came to be interested in it. And then I want to summarize 2 economic objections that, as far as my fellow economists, what they say against Bitcoin or what the general public might be worried about Bitcoin, and then, my response. And if we have time, I'll have questions, or I'll be hanging around a little bit later. So my background is, and on the schedule it mentions Mises, that refers to a very famous economist of what's called the Austrian school, and that's the school of thought that I believe in, and one of their key contributions to economic theory is their understanding of the business cycle. Okay, so I think just about everybody recognizes there's a danger with the state controlling or heavily regulating money and banking, right? Just like everybody kind of knows it's a bad idea to let the state run the media or to run the schools or to run car companies, even though those are no longer hypothetical things at this point. They can see how the state being involved with money could be a potentially very dangerous thing, right? So that's standard, but most people, when you say, well, why is that a problem? They'd say, 2 things. Well, there could be hyperinflation if they create too much of it, and we have historical examples, interwar Germany, more recently in our time Zimbabwe, where we see what happens if the state just dumps too much money into the system. And they can also reward their crony friends if they have the control of the money, so that's also a concern that the average person has, that the little guy's probably not going to benefit from a system in which the state has its hands in the money. But the Austrians say something a lot more subtle. They say the familiar boom-bust cycle that we associate with modern capitalist economies, that's actually not something inherent to the nature of the free market. That's not just, yep, that's the price we pay for prosperity, that you have wild upswings and then there's busts, but if you want to have that growth and dynamism, that's what we have to accept. No, the Austrians say, on the contrary, even that pattern is because of state intervention in money and banking. And the idea is the state comes in, floods the credit markets with money, pushes down interest rates, and that gives a false illusion of prosperity that's a boom period, but it's unsustainable. Okay, so that's where I was coming from. I went to school, I studied that, I did my dissertation in this area, and I was going around and involved with groups like the Mises Institute, which is named after this economist who subscribed to this and developed this theory. And so we're going around telling people that the way you not only protect the value of your money, but also avoid this boom-bust cycle is to take money and banking out of the hands of the state or out of its heavily regulated hands and return it to the private sector. That historically, money and banking arose from the voluntary private sector. It's not like some king invented money. It came, from the market. And so the way to safeguard that stuff is to return it to the private sector. So that's where we were coming from. And in this realm, it tended to be, we favored hard money like gold and silver, okay? And that were commodity monies. And then we were very skeptical of fiat money. Now, I'm sure most of you know that term, but there's video here just in case people don't know. So fiat money means it's not backed by anything. It's just the monetary item is what it is. It's not a claim on anything else, okay? And it's not useful for anything else except to serve as money. Whereas gold coins back in the day, you could melt them down and use it for industrial purposes, or you could turn them into jewelry. That gold was valued before it became money. All right, the monetary function piggybacked on the pre-existing industrial and consumer usage. Okay, so for a long time, many free market economists, people who would probably call themselves libertarians, they had in their minds that commodity money was created by the market and was good and was hard, and the virtue of gold and silver was you couldn't just flood the earth and double the supply of gold like that, that there were, scarce, physical scarcity constraints on that. And that was a virtue of it. So you didn't have to worry about a massive hyperinflation. And also it was decentralized, right? No one group owned all the gold mines, and that was considered a virtue of it. for people who were skeptical of giving too much power in the hands of an elite group. And then in contrast, most free market people were really afraid of fiat money because, again, that historically had been associated with the state. So partly what I'm doing here now is to not only give you guys my background, but also so you understand, as I'm sure many of you have experienced, one group of people that you would have predicted would love Bitcoin and embrace it with open arms, and cryptocurrency more generally, would be the sort of the people that were really into economics and really into free markets and libertarian political philosophy. But actually there's a group of them who were very skeptical of Bitcoin, downright hostile. And so I'm just explaining to you, it's partly because here was something that was coming from the market, was clearly not created by the state, and was very decentralized, and yet, according to that bifurcation, was a fiat money. It wasn't that people were using Bitcoins for industrial purposes, and then someone said, oh, you know what, this would be a good medium of exchange. No, it was designed from the get-go to be a system of payment or a currency and a payment system, okay? So I'm explaining to you that, just that knee-jerk hesitation that some people have had. If you want to see that more, we write it up in our Understanding Bitcoin guide, and then last year at the 2014 talk I gave at this conference, I went into that in more detail. But let me deal with two different objections today that, again, are more generic economic objections. So one is people say Bitcoin is deflationary, and they think that's a bad thing, right? And we have been conditioned, certainly in the United States, I know we have people here from other countries, I don't know how much of it is in Europe and so forth, but certainly here, deflation is the boogeyman. And people are like, oh, we can't have deflation. And that's, Federal Reserve officials explain to people why deflation is a horrible thing, and that's why we need to do these rounds of QE, and we're doing everything we can to avoid deflation. And why do people think that? Why is deflation so scary? And you can see the connection to Bitcoin, because Bitcoin tops off at 21 million units of it, and then that's it. And so if more people start embracing it, the demand to hold Bitcoins goes way up, and population grows and so on. So you can understand how if the production of cars and houses and food keeps going up while the absolute number of Bitcoins is fixed, clearly you would expect that the exchange ratio between those would change. So the price of things quoted in Bitcoins eventually would start going down. Bitcoins would become stronger and stronger in terms of their purchasing power. And so that's what most people mean by deflation. That's what they mean, that the prices are falling quoted in that currency. And so since we've been conditioned to think deflation's a horrible thing, and our valiant saviors at the Federal Reserve and so on, ECB, the Bank of Japan, are out there doing their best to ward off deflation, why in the world would we voluntarily embrace some currency that's got that aspect built right into it? Okay, so that's the logic. So a couple ways to diffuse that particular concern. One is to say historically, partly where this fear of deflation comes from is historically it's associated with very bad economies, right? So during the Great Depression of the 30s, there were falling prices, okay? And there's other periods where prices fell when things were bad, but I would argue that the causality was the other way around, that partly what was going on there is people were concerned because the economy was so terrible, and so what do you do when you're afraid? You don't want to invest in companies and things like you rush to liquidity, you rush to hard money. And so that's why often you see in periods of panic, people rush to the money, and so you see prices of other things quoted in money fall. So there, it's not that the falling prices caused the bad economy, it's the other way around, okay? There's also periods in US history when the dollar was strictly tied to gold, where you see consumer prices were gently falling over time, and it was a period of prosperity, right? So if you think about it, just in general, if the amount of real stuff is growing faster than the amount of money, other things equal, you would expect the price of those things quoted in the money to go down, right? Because the same dollars are chasing more and more real things, the dollar price of stuff goes down. Think of it like that, all right? And so, in general, falling prices are actually a good thing. Right? You as an individual having a certain amount of money at your disposal, the cheaper everything else is quoted in that means the more stuff you can buy, okay? So it's odd that we've been conditioned to fear that. But now a little bit more technically, really what you study economic theory, you see that the real issue with money, it's not that the money per se makes us richer or poorer, right? Money is, and if you were here yesterday, you saw George Gilder's talk, and this is partly what he was getting at here, is that money, don't think of it as something that's materially wealth and giving us a higher standard of living because of its physical properties. It's helping us communicate with each other. It's an information transmission system, okay? And so when you think of it like that, here's just a simple thought experiment. If all of a sudden, let's say we're using dollars, if the number of dollar bills doubles, clearly we're not all twice as wealthy, right? If you as an individual, if your dollars doubled and everyone else stayed the same, then you would be a lot wealthier, but it's not because humanity would be more capable of producing cars and mansions and yachts and movie theaters. It's just because you would now have the ability to bid away more of that fixed stockpile of stuff, and everybody else would be a little bit poorer. The people who had dollars who didn't see their stockpile go up, but yours magically did. Okay, and so if you just think through the logic of that, I hope you can see my point that if we all went to sleep tonight and then woke up tomorrow and our bank balances were all doubled, quoted in dollar bills, we would not all be as rich as we thought. We would go out into the marketplace and find that prices quoted in dollars had gone way up. So initially you'd be surprised, bank error in your favor, your checking account doubled, but then you'd go to the store and find things were more expensive, okay? And so you'd see, oh, wait a minute, this wasn't the boom that I thought it was. And in fact, if you think it through, we would all actually be worse off. It wouldn't be a wash. It's not that everything would just magically double. Some things would go up more than double, some things wouldn't go up as much. Some people would get to market first and spend their new dollars and they would benefit, and other people would be caught holding the bag and they would lose out. So you can see it would be a discoordination. Okay, so that's, when you realize that, it's not the total quantity, absolute number of dollars that matters, it's how well does it allow us to plan things and to facilitate our transactions. That's what the social function of money is. It's a communication or information device. Again, as people going back to Friedrich Hayek pointed out in George Gilder's talk yesterday in his paper in the Proceedings, if you really want to pursue that further. Okay, so in that regard then, really what economists will tell you is the problem with deflation, if they mean falling prices by that term, the problem with that is when it's unanticipated. Okay, so where it could really bite you is you go out and buy a house, take out a 30-year mortgage with a fixed monthly payment quoted in the money, dollars or euros or whatever, and then all of a sudden there's a change in the purchasing power of money and your salary goes way down. Okay, and even if the things in the grocery store also get cheaper, nonetheless your mortgage doesn't get cut in half. Okay, your fixed payment. So that's the kind of thing, especially historically, where people say deflation was a really big problem, that farmers, for example, who took out mortgages thinking that the price of their goods, their crops were going to be a certain thing, and then prices collapse, they got stuck because they still owed the bank that fixed dollar amount. Okay, so what that really means is it's not inflation or deflation per se that's the issue, it's predictability. And so once we realize that, you see Bitcoin, far from being a liability, the fact that it tapers off and caps out, and that at any given time we can predict fairly well how many Bitcoins are going to be in existence in the year 2038. You can't do anything like that with fiat government money, and even with gold and silver, you're not as sure. I mean, technically, an asteroid could crash on Earth that has all kinds of new tons of gold, for example. Okay, so even with something hard like gold, technically, we don't know exactly how many tons of gold there will be in humanity's possession in the year 2200. We really have no idea, whereas we know precisely how many Bitcoins will be in existence in the year 2200, okay? So that's actually a virtue of Bitcoin. Okay, I just got a few minutes left. Let me deal with one other objection. And again, if I've piqued your interest, go to understandingbitcoin.us to read more of these. The other objection that's very subtle, oh, am I getting gonged?
You can have 10 more minutes.
Okay. She said I can have a little bit more time, so that I'll start juggling after this point. Last thing, the main thing I want to talk about here is mining. Okay, so here it's a little bit of a subtle objection, but obviously you guys come to this conference, so you're a step ahead of the crowd here, so let me walk you through it. The objection runs like this. It says, in the original vision of Bitcoin, like in the white paper and so on, and the way its boosters promote it, they say, oh, it's this decentralized system. Nobody is in charge of Bitcoin, because it's the community itself decides what makes it onto the ledger or not, okay? And so that's the supposed virtue of it, but they said, look, in practice, you see these mining pools, and look at how much power they have. Look at the percentage of the computing power devoted to maintaining the blockchain that is effectively under the control of just a few key people, just in practice, the way these mining pools have developed. And then some economists have taken it further and said that's not an accident, that's not a coincidence. the very nature of Bitcoin mining has what they call economies of scale. And so we should predict, as this progresses, if Bitcoin takes off and more and more people embrace it, and that means more and more people are willing to pay money to bring in big processing power to get into the mining and so on, the allegation is that since there's economies of scale, we should expect this to continue, that it's just going to merge and merge and merge until there's going to be, at best, two giant cartels controlling all of the mining, and who's to say that they're not going to get in cahoots with each other? And obviously that defeats the purpose. So instead of us having a bunch of central banks right now, we're going to have one or two central banks running Bitcoin, and that these key people are going to control it. And the perversity of it is the individual miners who join those pools might do so unwittingly and not realize that they're serving nefarious purposes, right? Because the way the mining pools work is you tie your computer into it and you do part of the processing without really seeing the big picture. Okay, so that's the allegation. And so the way we handle that in our guide is to say, you know, and I hear as an economist, I mean, I understood the economics of it, but I needed to really make sure I understood the way the mining worked and so on. So I talked to Paul Snow and a bunch of other people. So we said, no, actually, as an individual miner, the reason you would join a mining pool, it's not to increase the expected payoff, right? It's not that you're going to earn more Bitcoins per week of your computer's processing time. Actually, you'd expect it to go down a little bit because there's overhead on the mining pool. The reason you would join the mining pool is to lower the volatility of your payoff, okay? And so an analogy is if there's you hear that, oh my gosh, some guy dropped, he had a bag of gold coins and he was walking out in a field and there was a hole in it, and we know there's gold coins spread across this huge field, but we don't know exactly where they are. And then you got 1,000 people who show up who are going to go look for it. And it's finders keepers, right? Just suppose, you know, if you find it, you get to keep it. You don't have to give it back to the guy. Okay, we could just all go out and look for it, and we could figure out how much total square area is there, you know, how much of that can you see with your eyes and not miss it, and you could just run some quick probability, how fast do I walk, and that sort of thing. And you could figure out per hour of me walking around this field, how many gold coins am I likely to find per hour of my search time. All right, now, the problem is if we all go out and do that, we don't know exactly where the coins are. Somebody might get lucky and find 10 of them. Somebody else might be looking for 10 hours and find 0. Okay, and so we could all agree beforehand, hey, you know what, instead of having these huge winners and losers, why don't we just all agree we're all going to search, and then we'll split, you know, we'll pool it together at the end, how many gold coins as a group we find, and then distribute them in a more even fashion. And somebody might say, well, hang on though, I'm taller, I walk faster, and I have better eyesight. I'm going to find more gold coins per hour than you will. And so if we could, you know, verify that, we might say, okay, you get out of the pot, you know, we're going to give you twice as many as we give to this person over here. But the point is, why would anybody agree to do that? It's because it takes the uncertainty, or it reduces the uncertainty of it, or the volatility. So now we're more confident that if I'm in a group of 1,000 people, we're going to go find some of these gold coins, and I know I'm going to get some of it. Okay, but clearly, it's not that by joining the group, everyone in the group is going to get more gold coins total than they would have if they all looked individually. That's not going to happen, right? You're not making your search more efficient by joining people. You're making it less risky. Okay, and so that's the logic of what happens with the mining pools. That's why you would join them. It's not that your computer now, that you're going to earn more Bitcoins per hour you devote of your search time or processing time. So once you see that, you realize there aren't inherent economies of scale in the operations. So the analogy we use in the guide that we wrote is to say, it's sort of like, imagine there's some Midwestern city in the United States that's just getting introduced to like Thai food, okay? And so in the beginning, there's only maybe a few people who are, you know, from Thailand or something moving there, and they start the restaurant, and just a few adventurous people are trying it. And so in the beginning, there's only gonna be one restaurant in town that serves Thai food, right? And some naive observer might say, you know what, the Thai restaurant industry is clearly one exhibiting economies of scale. There's just one restaurant, and that's it. And they might say, no matter how much the demand for this grows, 100 years from now, this restaurant's just going to get bigger and bigger until it's serving millions of people a day, serving them lunch. And we realize, no, that's not what's going to happen. Yes, there is economies of scale for a small amount of customers or meals served, but after a while, another Thai restaurant would open down the street, and then another and another, as the demand in that community for that particular product grew. And so that's what we think is happening with Bitcoin mining, that yes, there are economies of scale for a little while, a small range, but at some point, actually, you would expect other mining pools to operate. All right. So in other words, as an individual miner, it makes total sense for you to join a group of 99 other miners, but it doesn't necessarily mean that 100 miners would want to join a group of 10 million miners, that at some point that logic wouldn't work. Okay, I see some people, so let me stop right there and I'll field your guys' questions for a few minutes.
Hi, my name's Jez. I was a professional miner. I had investments in some big mining companies. I'm so sorry, but your understanding of the mining business is completely wrong.
Okay.
I'm sorry.
Well, thanks, everybody. I'll see you next year.
The reality is that mining is dominated by some very large companies that own most of the mining equipment. And actually, the home miner is, a tiny minority now of all miners. So your understanding is based on mining pools, which is technically correct, but the actual people doing the mining are not small home miners anymore, because it's uneconomic to do that, because the cost of mining is largely the cost of electricity now, and there are certain geo places in the world where electricity is cheap. So the professional mining is all happening in the low-cost energy areas, like Washington State and Iceland, and huge companies dominate mining now, and your understanding is based on a year or two's mining world, not today's mining world.
So the question was, how did I give such a fabulous talk? And thank you very much.
No, I love your talk, and your logic is correct, but your assumptions are wrong.
Yeah, I'm partly repeating it for the video. So he's saying that the analogies I was giving there are outdated, and now it's the cost of electricity is part of the issue, and there's huge mining pools. But even there, though, are you predicting that 100 years from now, why wouldn't there be several main players around those particular?
I think there's only 3 main players right now. Maybe.
And so 100 years from now, just 3 people are going to have access to cheap electricity?
Now. No, I think there is a serious problem with mining.
Okay.
Because the current cost of Bitcoin makes it marginal to mine. And so costs have been squeezed, and now only the very big players that do have economies of scale, they're the only people that can currently mine profitably. And even then, it's very marginal for them at the current price of Bitcoin.
Okay.
So I think there is a serious problem.
Okay, and so this is, I'm not trying to evade it, but this is part of the issue of my co-authors. Afterwards, certainly want to grab you. In my defense, we were clearly dealing with we were quoting the objection, and we were dealing with the objection that was raised to Bitcoin. Okay, so this is slightly different, and yes, I don't want to just throw something off the cuff here, and so yes, I do want to grab you afterwards and see if we can refine that. Thanks.
Okay, so I will go back to the fixed monetary policy, like 21 million. So you seem to like it because it's predictable, but cancer is also predictable, and people don't really like it. So most people just get cancer when they get old.
I'm sorry, what's predictable?
Cancer is equally predictable and risk-free. You are just going to get it, sooner or later. So, I don't think that von Mises would like the Bitcoin monetary policy because it lacks price elasticity, so it does not respond to the market at all. So, like, if the market wants more gold, a lot more gold will be extracted. If the market likes to buy Swiss francs, eventually the Swiss central bank decided to let them. Okay, so. What do you think about the lack of price elasticity in the Bitcoin monetary policy?
Okay, so the question is, with something like gold, which clearly Ludwig von Mises was a fan of, if the demand to hold gold goes way up, the purchasing power of gold goes up, and that gives an incentive for miners to go dig more gold. Okay, and so the price doesn't have to move as much, whereas with something like Bitcoin, if the absolute quantity is fixed, then the purchasing power would have to swing more based on changes in the population. That certainly is true, and I guess what I'm saying is that we can predict those swings. So part of the issue is that there would be a big jump if the world embraced Bitcoin, and it's sort of like a chicken and egg problem, that as more people move to it, they're doing it because they find it advantageous, and so it's. In other words, we're saying Bitcoin obviously won't work because what if everyone thinks it's awesome and wants to use it? And so, there's that element.
I wanted to thank you for the talk. I really appreciated it. I liked the way you described deflation being not necessarily a bad thing, and I wanted to make a comment that I also think that the sign of a healthy economy is actually deflation. a healthy, productive, growing economy would be deflationary. And the fact that we see inflation everywhere is actually a sign that they're not healthy economies. But my question is, how do you see the role of debt in a deflationary, healthy economy?
Okay, so the question is, and then I think after these two questions, I got to stop. The question is, what happens with debt in a deflationary economy? And again, so that, and it's a good question, and that is the concern among mainstream economists. Why is deflation so bad? It's when people have fixed denominated debt that doesn't itself adjust to changes in prices. And I mean, one thing is people shouldn't become as indebted. That's one thing. But even there, again, what catches people off guard is when they didn't expect it. Okay, so if you're going to sign a 30-year mortgage, but you knew ahead of time that, gee, you know, let's say the world's all using Bitcoin, or so people in the year 2200, they still are going to borrow money from banks to take out mortgages to buy homes, and you know, you wouldn't agree and say, I'm going to pay you 1 Bitcoin a month on this mortgage payment for 30 years if you had known your whole life that prices of things quoted in Bitcoin keep going down and salaries every year tend to go down by 8% quoted in Bitcoin. You would not agree to that. So again, the issue with people getting stuck with fixed value debts when prices go down is that they weren't expecting those huge collapses.
So part of my question was just asked earlier, but I'll do a follow-up question.
Okay.
So you're right, the inflation in the Bitcoin space is very predictable, but the price of a Bitcoin is not.
Right.
So that's the real inflation-deflation dynamic. So let's say in 20 years, when there's really no new Bitcoin being created, how do you stop the world from screaming, we need a Bitcoin central bank to control the whatever fluctuation there is to adjust for a growing economy? Basically, how do you prevent the creation of a Bitcoin central bank after the fiat goes down and the world is on crypto?
Okay, so the question is, even if the thing levels off at 21 million, if the demand changed where the prices could still fluctuate, wouldn't there be, how do you stop people from screaming? I can't stop people from screaming. They're going to scream. I'll guarantee you that right now, whether we use Bitcoin. See? Security. All right. But again, you could say that about anything. And so I think it's, you know, I know you're just playing devil's advocate, but it's sort of people are saying, you know, oh my gosh, there could be a central bank with this, so let's just rest content with our current central bank that we know is screwing us over. So the virtue of Bitcoin is it's extremely decentralized. Yes, if Martians showed up and said, you better all swarm a central bank or we'll blow up Earth, maybe it would happen. But in terms of realistic scenarios, this is the best way to prevent a central authority from taking over the currency. Do we have time for one more? Okay.
You should include velocity in your model, clearly. That you know, the assumption of monetarism is that velocity is constant, but we've now know that velocity is anything but constant. That's monetary turnover, which would affect Bitcoin as much as any other currency, and will tend to give the power to the people who hold it. Rather than to some central Bitcoin bank or whatever. Bitcoin, the people control the currency through velocity, through their speed with which they choose to spend or invest it.
Okay, yeah, and so great observation saying the purchasing power of money is not just the number of money units, but it's also how fast does it turn over, or what's the demand for the public to hold it. Look, if tomorrow everyone said, I don't like dollars, what would happen? The dollar price of things would shoot up, right? Because merchants would say, you got to give me a lot of dollars because I want to keep my goods, right? That's what happens in hyperinflationary economies. They don't want the currency, and that's why prices for things shoot way up because nobody wants the money. And so there, it's, you know, same kind of phenomenon that, at least with Bitcoin, my point is, one variable that we can lock down and control is the quantity of the actual currency. And yes, no matter what, in 2200, if people all of a sudden dump Bitcoin, Bitcoin prices are going to fluctuate. Okay, thanks everybody.